So calculate the value of the firm's equity at T given that the principal amount due on the zero coupon bond is 50 million and the total value of the firm at T is $60 million. In addition, what is the value of equity if the value of the firm is $40 million? So value of equity will be value of the firm minus the value of the debt. So value of the firm is given to be 60 minus the value of the zero coupon bond is given to be 50. So if the firm value is 60, then 10 million will come to equity, 50 million will go to debt. If the value of the firm on the other hand is 40 million, then nothing will come to equity. Even debt won't fully get paid, even debt will get 40 million, or the value of equity will be 0. Calculate the value of the firm's debt at T given that the principal amount due on the zero coupon bond is 50 million and the total value of the firm is $40 million. In addition, what is the value of the debt if VT is 60 million? It's the same question, we already solved it. In this case, however, the value of debt is asked, not the value of equity. So please note, in the best case, we will pay back whatever is due. So if VT is greater than K, the value will simply be K. So as 60 is greater than 50, payoff will just be 50 million. If VT is less than the strike price, then the value will be VT, because that is the best I can repay. So if the value is only 40, then debt will only get 40, or there will be a credit loss to the tune of $10 million. So in the question, Superior Incorporated has a 10% semi-annual coupon bond outstanding that is maturing in the next 3 years' time. Information on the risk-free rate and the credit spread for the next 3 years is given in the following table. Assume all rates are continuously compounded. That means 100 would become 100 e raised to power RT at the end of t years. Or the present value of 100 would be given by 100 divided by e raised to power RT if 100 is coming t years later. So the time is given, the risk-free rate is given, the credit spread is given. Credit spread simply implies that to value a corporate bond or to value a risky bond, we won't discount by 0.15. We would discount by 0.2%. To discount a cash flow back which is 1 year later, we will use a discount rate of 0.26%, so on and so forth. This is how much the individual cash flows, or this is the rate or the spot rate applicable to the individual cash flows of the credit risky bond. It will be the yield on the risk-free bond, rather it will be the spot rate on government bonds or from government bonds plus the credit spread. So to 1 year cash flow will be discounted back at this rate. Whatever cash flow or coupon is coming at the end of 1.5 will be discounted back by this rate, so on and so forth. Compute the present value of expected loss for the payment due in 2 years and second for the entire bond. Now, if it is a 10% semi-annual coupon bond, par value is not given. Let's assume the par value is equal to $100. Generally, par value will always be 100 or 1000. So assuming the par value is 100, what is the payment due every 6 months? $5 is due at the end of every 6 months, and at the end of 3 years 105 is due. So if it was a risk-free bond, the present value would have been 5 e to power minus 0.0023, that is at t equal to 2, the risk-free spot rate is 0.23%. That is, all cash flows coming at this maturity will be discounted back by 0.23%. So it will be 5 into e raised to power minus 0.0023. However, the cash flow is coming 2 years later. Rates will always be annualized. That is, you have to multiply them with the number of years. So this will be the present value of a riskless cash flow of 5. However, our cash flow will not be discounted back by 0.23. It will be discounted back by 0.34%, or the value of the $5 that we are getting, because it has credit risk also, that is, it may not come. There is some probability of default. It will be calculated as 5 e raised to power minus 0.0034 into 2. This difference is called the present value, or should be equal to the present value of the expected credit loss for the payment due in 2 years. To compute the present value of the expected credit loss for the bond as a whole, we will first discount each of these cash flows by the risk-free rate, and then discount each of these cash flows by the risk-free rate plus the credit spread, and then take the difference of the two sums so as to get us the present value of the expected credit loss for the bond. Please do the calculation for 2 years right now, and please verify the whole calculation as homework. So please do it and verify the calculation for the 2-year payment. So please verify that this calculation would come out to be 4.977 minus 4.966, that is approximately equal to 0.011. So that's how we've calculated the present value of the expected loss for the payment coming at t equal to 2. We can similarly calculate the present value of expected loss for each of these payments and then sum them up to compute the present value of the expected credit loss or expected loss for the entire bond. So in the solution here, we have assumed $1,000 face value. It doesn't matter, the concept remains exactly the same. So the risk-free rate is given, the credit spread is given, hence the total yield for the risky bond can be calculated by summing the two, and as we sum the two we get the total yield. The cash flow is a coupon of $50 in each of the periods, and finally the coupon plus principal repayment at maturity. Present value at risk-free rate, for example at t equal to 2.5, would be 50 into e raised to the power 0.0028 into 2.5, because it's coming 2.5 years away. Similarly at t equal to 2.5, here would be 50 into e raised to the power, we're computing the present value, so there has to be a e raised to power minus, so e raised to power minus 0.0041, that is the total yield multiplied by 2.5, which comes out to be 49.49. So if you sum it up, this will be the present value of the risk-free bond minus the present value of the risky bond. The sum of the differences will come out to be 6.01, that is equal to the present value of the expected credit loss on the bond.